low base. Okay, the CPI inflation has come closer to where RBI is guessing, 5.02%. So that's truly triumphant and a relieved RBI. The number almost entirely in line with what they forecast. People were expecting that July, August, September would be an average of 6.5. RBI stuck to 6.4, expecting the number to come at 5. Price inflation is the one that's the most important factor. It's fallen to 6.56% compared to 9.94 in August. So 6.56, again, much lower than the CNBC TV18 poll of 6.8%. My sense is a large part of it would be a fall in vegetable inflation, maybe a 15% fall month on month, but we will just wait for all those details to come. So those are the two crucial numbers that have come down. Okay, food price index has come down 2.2% on the month, and the combined index has come down 1.1% month on month. We are still awaiting more details, and okay, we are getting some more details coming in. I'll keep you abreast. Cereals index is up 1.2% on the month. Now that is a slightly not very happy number. Up 1.2% on the month for cereals. So looks like we will still get a very high rice and pulses inflation. Okay, we now have the entire table with us, so I'll be able to read it out to you. Cereals inflation comes in at 10.95%, so almost 11% year on year. And as I just read out to you, the month-on-month increase is 1.2%. Okay, just as an aside, the August industrial growth has come in at 10.3%. So it's a tad better. Yes, there is a base effect of minus 0.7, but at 10.3, it's better than our poll of 9.5. So there's something to cheer. Inflation is lower than expected and growth is higher than expected. So both numbers positive. To go back to the CPI number, the more important one, I'll just read out the key year-on-year CPI rise. I told you cereals is 11%, 10.95. Meat and fish up 4.1. Eggs up 6.42%. Milk and milk products 6.89%. That's important because milk was reigning at about 8%. It's slowly starting to slip, probably because the base is also catching up. Oils and fats, another important one, that's down 14%. It's been falling. I mean, this is the post-Ukraine effect. So we still have a high base over there. Fruits up 7%. Vegetables, that's the big one, up just 3.39%. Remember, we were battling with 80% and 30% just 2 months ago. And the entire tomato impact and perhaps a little bit of onions also erased now, just 3.39%. Pulses is a big one, 16.38%. So that's where the next point of worry for the government will be. Early indications are that it's falling in October, but at the moment we only have this number to go by, the September number, and that's not at all comforting. Likewise, spices, 23%, continue to remain a high inflation area. Sugar down to 4.5%, and that's the main in terms of food. So food and beverages as a whole is up 6.3%. Clothing up 4.6%. Footwear up 4.07%, so nothing very significant. Housing is just 3.95%. Let's just look at the miscellaneous number. The miscellaneous number, which is the largely the core number, is up 4.77%. So that's the services number, basically. Within services, household goods and services is 4.3%. Health is up 5.9%. Transport and communication, 2.28%. Recreation and amusement, 3.4%. Education, 5.26%. And personal care and effects, 8.54%. The big number, of course, that we worry about is food and overall inflation, coming benign at 5.02%. The overall inflation, and food CPI coming in at, 6.3%, if I'm not mistaken. Just a minute. Monthly change, of course, is minus 2.18% for food, And the overall food inflation, I'll just give it to you in a minute. Overall food inflation is, I think, 6.3%, if I'm not mistaken. Okay, 6.56%. Okay, that's the food inflation.
Magical experience.
A little more than that. Let me get to my experts. Madhavi Arora of Emkay, Rupa Rege of L&T Finance, Siva Kumar of Axis Mutual Fund, and Sakshi Gupta of HDFC Bank with us. Okay, so the ladies dominate. Rupa, let me start with you. 5.02, an extremely welcome number, you would say?
Yes, it is a good number, but point is that for inflation expectations, for inflation predictions, we shouldn't be having this backward-looking approach.
Okay.
And you have to, as you have mentioned, the real pressures are now coming from cereal prices, pulses prices. And in the past, we have experienced that whenever we had subpar monsoon rainfall and extremely uneven distribution, we have always suffered inflationary pressures from the food economy. And that combined with what's happening in a geopolitical front and its consequences for oil prices, I think we need to stay vigilant rather than get excited by just 1 month's number.
No, I agree with you, but this is a fairly steep fall, and it looks like the Reserve Bank's nowcast had forecast a number like this. Madhavi, would you want to add to this the fact that, the number is coming in close to 5?
Hi, Lata. Clearly, the numbers are a big surprise, almost 30 bips lower than my expectations. And interestingly, the mix has come within the food itself, where we were not looking this sharp a correction in vegetables and this high, a number in non-perishables. So as Rupa mentioned, what we are seeing is that while perishables are, correcting, which was expected, and probably correcting much faster than expected or much sharper than expected, what we are seeing is that there are certain structural elements which are now getting very sticky with regard to cereals, pulses, spices. In fact, if you look at the data till 10th of December or the 10th of October, what we are seeing is that there has been a sharp increase in pulses, while cereals have come up a bit, but pulses is now looking to be a problem, while spices are very, very sticky. At the same time, I think meat, fish, as well as eggs, which are again protein component, would also be a little sticky in the coming 1 or 2 months. But more importantly, non-perishables is becoming a structural problem for the next 6 months or so. But that said, overall, there'll be a lot of offsets in food, which is what we saw in this release as well, wherein the sharp correction in vegetables sort of took care of the rest of the non-vegetable food inflation. And overall, we saw a downtick in, the inflation print, which obviously will put downward pressure in the upcoming trajectory as well, the numbers for the next month as well. So I think it's a pretty good number, although the mix is not as good as one would have liked.
Okay. Thanks for those initial comments, Madhavi. Sakshi, to you, food inflation now far less of a worry, or like Rupa and Madhavi, you would still worry that pulses can be a sore point?
Well, Lata, clearly this number is a big step down. And I think for starters, it does kind of, alleviate the fears and uncertainty around food inflation spikes, right? And we were worried about this, last month and the month before.
Yes.
So this very sharp cool off is very welcome. Yes, of course, that is not to say that, you do not have inflationary risks from cereals as well as pulses, in the coming months, which warrant, monetary policy to remain tight. But I think I am, a little optimistic also because of the fact that, with this cool down in food prices, we've also kind of avoided a more generalized spread to other inflation categories, particularly core. And this was one of the, fears that, if food inflation remains very high for an extended period of time, it might start spreading to, core inflation as well. So, for now, at least the headline inflation print has become more digestible. Again, there are risks.
I can make it more digestible for you, because the core inflation number now, of course, computed by Cogensis, is 4.5%. We had got an average of 4.7%, and this is still a very good step down. We've been losing about 10 basis points every month since the high of about 6% at the start of 2023. But this is a fairly steep step down, 30 basis points lower on core inflation. And going by the fact that globally as well, we are seeing metals and other elements contributing to core inflation in a disinflationary path. This looks like a very, very positive development, tends to be more sticky. Rupa, any more thoughts on that, core inflation?
No, there I will give entire credit to Reserve Bank of India's consistent policy tightening, and because a lot of demand pull pressures present in the inflation trajectory, they have managed to control well by giving right kind of guidance at the right time and keeping the policy very transparent, predictable, and they prepared the bond markets also well up the curve. So fall in the core inflation definitely is reflects the credibility of inflation targeting approach of Reserve Bank of India.
Fair point. You were a part of that committee, I remember, Rupa. Well, but now for the man on the street to tell us how this bond street is going to look at all this. Sivakumar, this must be manna from heaven already. Not seeing an OMO has brought down yields from 7.35 to 7.3. With this number, do you think there are more gains to be made in the bond market tomorrow?
Hi, Lata. Yeah, I think the short answer is probably yes. That you should cheer this. Market went in, I think, with over a period of time, one should expect that if this food shock is transitory, as RBI is also hoping, and inflation starts moving towards 4.5, and it'll go a long way towards hitting that 4% mark that the governor has explicitly said that they are trying to target. So remember that from a monetary policy perspective, the RBI has slightly shifted the goalpost and said that they are no longer just going to sort of be comfortable with a range of 4 to 6, but rather they'll be trying to get inflation closer to 4.
Yeah.
So all of this, I think, goes a long way towards giving that kind of comfort. So I think, yes, there is no two ways of putting it. A 5% inflation print is really, really welcome. Core is really, really welcome.
Okay.
Now to the other points which I think are important because you've raised them, which is things like geopolitics and the rise in oil prices. You must remember that it's not getting passed on, right? The transportation and inflation fact, sub 4 clearly reflects the fact that petrol and diesel prices are not being revised. So therefore, the fact that global prices of petroleum crude and petroleum products are rising is not really transmitting to India, at least for now. So as long as that's the case, then I think from RBI's perspective, they will be able to maintain more of a wait and watch rather than to sort of fret about inflation, at least in the near term.
Oh, absolutely. I mean, at the moment, Brent prices are at $87. The International Energy Association, the IEA, has just said that it has downgraded demand. But anyway, at the moment, that's a separate issue. The point is that there's just about every bit of news on inflation that sounds extremely welcome, but it pales into insignificance when you look at the bunch of good news that's coming on industrial growth. It's not simply that overall industrial growth for August has come in at 10.3%. Even some of the components, electricity sector is up 15.3%. Yes, there is a base of just 1.4 year ago, but that's still a very good number. Likewise, manufacturing has come at 9.3. Again, this entire August month was terrible, August of 22. And so you're going to see everything doing much better. But I can pick out something like capital goods. It was 4.3 year ago. It's 12.6 now. So although the base was not terrible, it still has done an excellent 12.3% rise. So all over, it looks like the industrial growth number for August is a tad better than expected. Yes, the minus 0.7 of a year ago was a help, but even if you took the average of both minus 0.7 and 10.3, you still come with an average of about 6% or 5.5%, which is a very good number. Incidentally, the July industrial growth number has been revised upward slightly from 5.7 to 6%. So we will make that correction. We are carrying the older number 5.7, but it's now been revised higher to 6%. So Madhavi, on that?
So I think IIP numbers again are very much in line with our expectation. We were expecting it to, hit close to 10%, and again, the big driver would essentially be, all the components within the sectoral classification, be it mining, manufacturing, electricity, overall. I think manufacturing has done pretty well, if I may understand, and sequentially also it was looking to be very strong, probably tracking, the uptick in exports that we have seen in the past month. Plus, the PMI also was sort of hinting at a strong manufacturing growth, in the last 1 or 2 months. So I think that has sort of been reflected in IIP, and I think on the last 3-month moving average also, I think IIP looks to be a healthy print. So that should augur well for this quarter's, manufacturing GDP number as well.
Okay. Only consumer non-durables month on month is not showing an increase. All of them are showing an increase year on year because the year ago number was terrible. Year ago number was -9 for consumer non-durables. It's come in at 9. So basically, consumer non-durables looks flat, which kind of gels with the fact that we haven't seen a very good informal sector or rural demand. Consumer non-durables, that is, with consumer durables up 5.7% over a -4.4. So that again shows that probably if you cancel out the base, it's about a 2 to 3% growth. This is largely a base effect, but I want to again be at pains to point out that in things like capital goods, it looks like even with a base, even without a base effect, it's a good number. Any additions, Sakshi Gupta, in terms of growth?
Yeah, I think Lata, this IIP number, you're right, of course, there's a huge base effect. But I think that, as you pointed out, if you look at some of the month-on-month numbers, even in the, core sector data, it kind of shows you that economic activity continues to hold up well. I mean, of course, we know there are headwinds coming in from, the global growth slowdown in our major trading partners. But it gives you a sense that domestic economic activity continues to hold up, and we're not seeing a major red flag coming in now. I think for me specifically, I was watching out for the consumer non-durables number, and there has been a lot of fear about the impact of monsoon, erratic rains on rural demand. But I think that also is somewhat better than what you would have expected.
Okay, ladies and gentlemen, Sivakumar, I have to take a quick break and I'll be back. I just want to get your forecasts for both growth and inflation back in a jiffy.